Income taxes. Okay, the first question, a company's income tax expense equals to what? So income tax expense equals to what? Income tax payable plus change, this is the key word, change in net deferred tax. What is your net? What do you mean by net? Deferred tax liability minus deferred tax asset. So what is the correct option now? Is C correct? A is correct. Is a company's income tax expense is equal to income tax payable plus net increase in deferred tax liability minus net increase in deferred tax assets. So this is what? Change in net deferred tax. This whole expression is change in net deferred tax liability. This is incorrect. Option C. Why? Because net increase in deferred tax assets and liability. Actually, we are reducing what? Deferred tax assets. It is not increase in deferred tax asset. It is change in net deferred tax liability. When we talk about net deferred tax liability, we reduce what? Increase in deferred tax assets. Question number 2. Income tax paid. Income tax paid is equal to what? It should be equal to income tax expense. Not necessary. This is the whole reason why we have deferred tax liability and deferred tax asset. What about option B? Does it reduce income tax payable? Yes. So if your income tax payable is $100 and you paid income tax, let's suppose of $80, then how much is your income tax payable? It goes down. So option B is correct. Income tax paid is a provision for the amount of taxes to be paid and not a cash flow. Actually, it is what? It is a cash flow. Question number 3. Accounting profit. Accounting profit. Where do we report accounting profit? In income statement. Income tax payable. Income tax payable. Where do we report income tax payable? In your balance sheet. Do we report it in your income statement? Absolutely incorrect. Income tax payable equals to income tax expense plus change in deferred tax. Again, it is actually income tax expense equal to income tax payable plus change in net deferred tax liability. It is the other way around. So option B is incorrect as well. Question number 5. Using accelerated method of depreciation for reporting purpose and straight line method for tax purpose would most likely result in what? So this is your reporting purpose and this is your tax purpose. So we are reporting accelerated method. Accelerated method is maybe your double declining. So depreciation expense is higher over here. So your earning before tax would be lower and your taxes would be lower. In your tax book, we are using what? Straight line method. So your depreciation would be relative to your accelerated would be lower. Your EBT would be higher. And your taxes again would be higher. So if you are paying more taxes, then deferred tax asset is generated or deferred tax liability? Deferred tax asset. So if you would have used double declining in your tax books, then your deferred tax liability would have been generated. But over here, what is generated? Deferred tax asset. So do we have a deferred tax asset in any of the options? No. So we are quite sure that deferred tax liability is not generated. Valuation allowance is used to reduce deferred tax asset. Over here, we are talking about deferred tax asset being generated, not valuation allowance. So this is also incorrect. The correct answer is that it is a temporary difference. In accelerated method, your depreciation is higher in earlier years, then it goes down. Question number 6. To reduce the deferred tax asset, a company would most likely create a valuation allowance. Why would a company wants to reduce deferred tax asset? Why would a company wants to reduce deferred tax asset? Yeah, so we are forecasting that the future profitability, what is happening to our profitability? Profitability, it's going down. If profitability goes down, what happens to your losses? Losses obviously increase. Do we pay taxes when we have loss? We don't pay tax. So we are not paying taxes when we are incurring losses. So there is no use of deferred tax assets. When does the utility of deferred tax asset increases? When we are making profit. If we are making profit, then we are paying taxes. If we are paying taxes, then deferred tax asset could be used to reduce our taxes. So the correct option is A. A tax payable lower. A tax payable. This is your tax book. And this is your accounting book. Tax payable, where do we report tax payable? In your tax book or accounting book? Tax book. So tax payable is coming over here. So your tax payable is lower. So your tax over here is lower. Then income tax expense. So income tax expense come where? It comes in your accounting book. So your income tax, your taxes are higher over here. We paid lower. So what is happening? We paid lower. We should have paid more. It is your liability. So it's a deferred tax liability. Deferred tax liability are appropriately treated as equity. When? When do we treat deferred tax liability as equity? When it is a permanent difference. When it is a permanent difference. So the correct option is B. When they are not expected to reverse. There is a classical example. Now you need to understand. If a company keeps on buying assets, one asset, another, each year it's buying asset, then you need to also understand that it is not a temporary difference, it is a permanent difference. So if this is a scenario that in accounting books we are using straight line and in your tax books we are using accelerated method, but we keep on buying assets, then the reversal will not take place. The reversal will not take place. Then again we will going to report what? Instead of deferred tax liability, we will be reporting equity. Question number 9. The appropriate treatment of deferred tax liability when both the timing and amount of tax payments are uncertain is to classify them as neither liability nor equity. So if you don't know the timing and the amount, so it is neither liability nor equity. Why is that the case? We don't know the timing. We don't know when to pay and how much to pay. Can we come up with a liability amount? No. Can we say it's our equity? Can we say that we don't owe anything? No. So we don't account for this when we have a deferred tax liability, that when both the timing and the amount of tax payment are uncertain. So neither we report as liability nor equity. Question number 10. A tax payable higher than income tax expense. We paid more tax. Then what was expected? It is what? Deferred tax asset. Question number 11. In the current year, a company increased its deferred tax liability by 500,000. During the year, the company most likely became entitled to a 500,000 tax refund. Why? It's totally incorrect. You are not getting any refund. Actually, you increase your tax liability, deferred tax liability. reported a higher accounting profit than taxable income.
Yes.
So again, two books, accounting book and your tax book. If your EBT is higher over here, then what is happening to your taxes? Taxes are higher. If your EBT is lower over here, then your taxes are lower. So we paid low taxes and then what was expected. So what is happening? Deferred tax liability is generated. So in the current year, a company increased its deferred tax liability. So what is happening? Deferred tax liability is increasing. How would a deferred tax liability increase? You reported a higher accounting profit than taxable income. So your accounting profit was higher than your taxable income. This is the reason why your deferred tax liability would go up, and it makes intuitive sense as well. Let's suppose depreciation. Over here in tax, your depreciation would be higher, and over here your depreciation would be lower. If we are using double declining and we are using straight line over here, so if you are using double declining, depreciation is higher, your earning before taxes are lower, your taxes payable again lower than what is expected in your accounting books. So what will happen? Deferred tax liability would be generated. So option B is correct. I am again and again repeating this because I know you will going to make mistakes. Okay, question number 12. The appropriate treatment of deferred tax liability that are expected to reverse is to classify them as liability. Again, we are expecting them to reverse. If the deferred tax liability is not expected to reverse, then it should be treated as equity. Deferred tax liability is treated as liability when it is treated as liability when it is expected to reverse. When the amount and timing of future tax credit is uncertain, it is appropriate to. So is tax credit a temporary difference or a permanent difference? Permanent difference. When permanent difference, do we come up with deferred tax liability or deferred tax asset? No, we don't. So what should be the correct option? C. We should avoid creating a deferred tax asset because it is not a temporary difference. It is a permanent difference. Okay, question number 16 is one of my favorite questions. Let's do this question. If we talk about dividends, dividend is a story after net income or before net income? After net income. So after paying taxes, we come up with net income and then we pay dividend or whatever. Okay, let's do this question. So there is this company by the name of RKS or RCS incurred $275,000 in research cost, which were expensed in current fiscal year. As per the applicable tax laws, the research cost must be expensed over 5-year period instead of 1 year. So what is happening? Again, accounting book, and over here we have a tax book. So in accounting book, what are we doing? Expensing. Immediately expense. So if we expense this, what will going to happen to our profitability? EBT. EBT will go down, taxes will go down. If it is in your tax book, what is happening? We are capitalizing. We are going to divide them in how many years? 5 years. So 275 divided by 5 is how much? 55. So each year we are going to utilize 55. So EBT would be higher or lower? Higher, because we are not expensing, and your taxes over here would again be higher. So deferred tax asset would be generated. We are paying more taxes in your tax book and we are paying less taxes. Now, just as a school of thought, what should be your carrying amount in your accounting book? In your accounting book, your carrying amount would be 0. Why in your accounting book the carrying amount would be 0? Because we have already expensed. In your tax book, your tax base is carrying amount, but in your tax books, your carrying amount is known as what? Tax base. Your tax base over here would be what? 275 minus, how much is this? 220. Everyone? Okay. The company capitalized development cost of 1.5 million during the year, of which 250,000 was amortized. As per applicable tax laws, amortization of 20% per year is allowed. So your carrying amount over here would be 1.5 million minus 250,000. Your tax base over here would be 1.5 million, but your amortization would be 20% of 1.5 million, that is what? 300,000. So 1.5 million into 0.2 is 300,000. So 1.5 million minus 300,000 is what? 1.2 million. Okay. Account receivable includes a provision for doubtful debt about 375,000. As per applicable tax laws, a deduction of 30% of the gross amount is allowed for doubtful debt. So let's read the question further. Assume that the dividends are not taxable. The table below gives the carrying amount for the various elements. So the carrying amount is for your tax books or for accounting books? Accounting books. So dividend receivable is how much? 3 million. Research cost is how much? What's your carrying amount? 0. Are we surprised? No. Why? Because the research cost was expensed. And obviously if you expense, your carrying amount would be 0. Account development cost. So development cost is how much? 1.25 million. Are we surprised that your carrying amount is 1.25 million? No, we shouldn't be. Okay, so now we talk about account receivable. So your carrying amount is 1.6 million. So what would have been your original account receivable? Okay, so your carrying amount for account receivable is how much? 1.6 million. What would have been your original account receivable when your provision is 375,000? What should be your original account receivable? 1.6 million plus 375,000. How much would that be? 1.975 million. Even on top. So your original account receivable were how much? 1.975 million. And what is your provision? 375. So if we reduce 1.6 million minus 1.975 million, so in order to calculate your carrying amount, 1.975 million minus 375 will going to give you how much? 1.6 million. So we are told that account receivable, carrying amount for account receivable is how much? 1.6 million. Okay, let's do question number 16 first. The tax base for dividend receivable is closest to what? So we received dividend of 3 million. In your accounting book, what you will going to write? We received, and it is, dividends are not taxable. Dividends are not taxable. So what you will going to write in your accounting books? 3 million. What you will going to write in your tax books? 3 million. Because it is not taxable. So your tax base for dividends is what? 3 million. Now you need to understand this fact, this concept. Carrying amount and tax base, basically they are almost the same thing. In carrying amount it is for your accounting books. Tax base is for your tax books. Other than that, both of them are the same thing. Okay, question number 17 is the same question, but we want to find out the tax base for research cost. What is the tax base for research cost? So research cost You remember? 275,000 in research costs were expensed. But we need to, in your tax applicable tax laws, what we need to do? We need to divide it in how many years? 5 years. We have already done that. So 275 divided by 5 is how much? 55. Your tax base would be, original amount was how much? 275 minus this equals to 220,000. Question number 18. We need to find out the tax base for development cost. So your carrying amount for development cost is how much? 1.25. Development cost is total how much? 1.5 million. How much do we need to reduce? What is the amortization rate? 20% per year. Where it is applied? In your textbooks. So 1.5 minus how much? 300,000. From where this 300,000 is coming? 1.5 million into 0. This gives you what? 1.2 million. So the correct option is A. Question number 19. We need to find out the tax base for accounts receivable. We have already, half of it we have already done it. As per applicable tax laws, okay, account receivable includes a provision for doubtful debt of how much? 375. As per applicable tax laws, a deduction of 30% of the gross amount is allowed. Now, your provision is how much? Provision was for 375,000. What was your original amount of account receivable? So your carrying amount for account receivable equals to account receivable minus what? The provision. What is your carrying amount? It is already given to you, 1.6 million. This is what we need to. And what's your provision? 375. So X equals to 1.975 million. This is your accounts receivable. Now original account receivable. So instead of deducting 375, we need to deduct how much? 30%. So what is 30% of 1.975? 1.975 minus what? 1.975 into 0.3. Now this is your new provision. So 1.975 minus 1.975 into 0.3 will give you what? 1.3825 million. Question number 20. Income tax expense equals to what? Income tax payable plus change in net deferred tax liability. What's your income tax payable in 2017? 2300 plus change in net deferred tax liability. What's your net deferred tax liability? Net deferred tax liability is 70 for 2017 and 30 for 2016. What's the change? 20 plus 20. 2300 plus 20 is 2320. Can you calculate this for me? How are we getting this 50? What's your net deferred tax liability? That's your deferred tax liability minus deferred tax assets. What's your deferred tax liability? 350 minus 300 is 50. 520 minus 540 is 450 is 70. Question 21. A company purchased equipment in 2016 for 25,000. The year-end values of the equipment for accounting purpose and tax purposes are as follows. So your carrying amount is 35,000 for 2017 and tax base is 29,000. Which of the following statement best describes the effect of the change in the tax rate on the company's 2017 financial statement? So your tax rate was 30% and over here it is. So the tax rate has increased. So deferred tax liability is what? Carrying amount minus tax base multiplied by tax rate. Now, if we were using, what is your carrying amount in 2017? 35. What's your tax base? 29. And now you also need to understand that deferred tax, this formula, in the background, the carrying amount and the tax base, we are talking about as an asset. So over here we purchased an equipment. Now tax rate, if we would have used last year tax rate, this would be how much? 0.3. So your deferred tax liability would be what? 35 minus 29 is 6. 6 into 0.3 is 18. So 1800 would have been the answer. But 35 minus 29 multiplied by what's the new tax rate? So 6000 multiplied by 0.35 is how much? 2100. So there is an increase of how much? 300. So the correct option is A. Question number 22. In early 2017, Virgin Atlantic must pay the tax authorities how much? 45,000 on the income it earned in 2016. This amount was reported on the company's financial statement as 31st December 2016 as your taxes payable. What is your taxes payable? That is your liability. What is your deferred tax liability? That is what? Carrying amount minus tax base into 0.3. Over here they are just saying that you owed how much to the tax authority? 45,000. So this is what? Taxes payable. Income taxes payable. Question number 23. In an income statement, income tax expense equals to taxes payable plus the increase in deferred tax liability less the increase in deferred tax asset. Basically income tax expense equals to income tax payable plus change in net deferred tax liability. So what is your net deferred tax liability? Deferred tax liability minus deferred tax assets. Question 24. Okay, a company purchased equipment for how much? 250,000. It is depreciating the equipment over a period of 10 years on a straight line basis for accounting purpose, but for tax purposes it is using declining balance method at a rate of 20%. And given the tax rate of 30%, your deferred tax liability. Now at times you won't be given what is being created, deferred tax liability or deferred tax asset. So how do we know that which is being generated? So this is your accounting and this is your tax. Am I right? So where are we using double declining? So your depreciation is high. Your depreciation over here would be low. Your earning before tax would be low over here and your earnings before tax would be high. Your taxes over here in accounting book would be higher and in your tax books your taxes would be lower. So if you're paying less taxes than what you should be paying, then what is being generated? Deferred tax. First of all, we need to understand why this deferred tax liability is being generated. Okay, so what is the formula for deferred tax liability? That is your carrying amount minus tax base multiplied by tax rate. What will be your carrying amount? So 250,000 divided by 10, that's your depreciation, 25. So your carrying amount would be 250,000 minus 25,000, that is how much? 225,000 minus your tax base. So in your tax base, which method we are using? We are using declining balance method at a rate of 20%. So 250,000 minus 0.2 is how much? 50,000. Am I right? So what is the tax base? What is your tax base? Tax base would be 250,000 minus 50,000 that is equal to what? 200,000. And tax rate would be 0.3. So 225 minus 200,000 is how much? 25,000. 25,000 multiplied by 0.3 is how much? Multiplied by 0.3 is how much? 7,500. Do we find this option over here? No. Why? Because we need to find it at the end of 2017. This is a classical mistake. And you need to read the question. Okay? Carrying amount would be how much? So how many years have passed? 1, 2 and 3. So at the end of 2017, at the start of January 2015 we started. So the whole of 2015, the whole of 2016 and the whole of 2017. So carrying amount would be 250,000. Each year your depreciation is how much? 25. For 3 years it would be 25,000 into 3. So this would be how much? 175,000. Your tax base would be 250,000. But what's your balance method? What's your rate? 20%. So each year how much would remain? After the end of first year, how much would it remain? 0.8. And then 0.8. And then again 0.8. Are you getting this point? So 250,000 into 0.8 is your ending balance. And then again we multiply it by 0.8. So we will going to get the ending balance at the end of second year. At the ending balance at the end of third year. So what is tax base? How much is your tax? 128,000. So your deferred tax liability would be 175,000 minus 128,000 into 0.3. What do you get? 14,100. At the beginning of the year, a company purchased a fixed asset for 2 million with no expected residual value. The company depreciates similar assets on straight line basis over 20 years. While the tax authorities allow declining balance depreciation at the rate of 10%. Now, where is the depreciation would be more? Where would the depreciation, in which books? In your accounting books or in your tax books? In accounting book, your depreciation rate is 5%. In your tax books, your depreciation rate is 10%. So over here in your tax books, your depreciation is higher, so your taxes are lower. Over here your depreciation is lower and your taxes are higher. So we are sure that deferred tax liability would be generated. What is generated? Deferred tax liability. This option A is absolutely incorrect. Tax base. Now, which of the following statement is this asset at the end of the year? At the end of the year, this is absolutely incorrect. Tax base cannot be 2 million at the end of the year because a certain amount of depreciation would be deducted. And how much is the certain amount of depreciation? That is 10%. So 10% of 2 million is 200,000. So 2 million minus 0.2 is 1.8 million. Okay. Temporary difference of 100,000. So what is your temporary difference? That is your carrying amount minus your tax base. That is your temporary difference. So carrying amount would be how much? So your depreciation was 5%. 2 million of 5% is how much? 100,000. So carrying amount would be 2 million minus 100,000. That is your 1.9. What is your tax base? So 100,000 is your temporary difference. Option C is correct. Question 29. The most likely impact of a decrease in income tax rate. Income tax, not in income tax expense, but income tax rates is a decrease in deferred tax liability. So deferred tax liability equals to carrying amount minus tax base into tax rate. So deferred tax liability goes down if tax rate goes down. And one more thing, deferred tax asset will also go down. Maybe over here we deferred tax asset is being generated. If your carrying amount is less than your tax base, if it is an asset. If carrying amount is less than your tax base, then deferred tax asset is generated. If tax rate is going down, then again deferred tax asset will also go down. Both deferred tax liability and deferred tax asset will go down if tax rate goes down. Very important point. Either the case. Let's do question number 30. Okay, so the following data is available for a company. Now assume the tax rate is initially how much? And the deferred tax liability for 2016 we need to find out. So deferred tax liability equals to carrying amount minus tax base multiplied by tax rate. So what is your carrying amount? In 2016 it is, and for 2016 tax base is 17,007. This would be 18,000 minus 17,007 multiplied by 0.25. So what's your answer? B is correct, 248.25. Same question, but now assume the tax rate changed to 20% from 25%. Change in deferred tax liability due to change in tax rate in 2017 is closest to. So again, deferred tax liability is how much? Carrying amount minus tax base into tax rate. Now the difference is 1643, and your tax rate is changing from 25% to 20%. So we can simply, if we want to find out the change, we just multiply this by how much? 0.05, the change. Or either we calculate this for 25%, then again we calculate for 20%, and then what we need to do? Subtract. So we just multiply it by 5%. So what is the answer we are getting? 31 is C. 82.14. Question number 32. When certain expenditures result in tax credit that directly reduces taxes, it is most likely that the company will report no deferred tax assets or liability. Why? Because this is not a temporary difference. This is a permanent difference. It is a permanent difference, not a temporary difference. Question number 33. When accounting treatment of an asset requires it to be expensed immediately. So this is your accounting and this is your tax book. Over here we are expensing it immediately. If we expense, what happened to your EBT? It goes down. Taxes goes down. While tax rules require it to be capitalized. If it is capitalized, what happens to your, if it is capitalized, then we are not expensing. What happens to your EBT? Goes up. What happens to your taxes? Goes up. We are paying more taxes than required. So what is happening? Deferred tax asset is generated. So for tax purposes, the company treats advance payments from customers as immediately taxable. So we have tax book and we have accounting book. So if revenues are increasing, your EBT will go up. Why revenues are increasing? Because we are treating advance payment immediately. So for tax purposes, the company treats advance payment from customers as immediately taxable. So EBT goes up. EBT goes up, your tax goes up. But for accounting purposes, the advance payments are not recognized until the company's obligations is fulfilled. So the taxes over here would be lower. So we are paying more taxes. Why the taxes would be lower? Because the revenue is not increasing. This is not happening because we are not immediately recognizing it. So what will we do happen? So we are paying more taxes than in your compared to your accounting books. So a deferred tax asset is generated. The consequence of recognizing expense which is required under the accounting standards but not permitted under tax law. Is it a temporary difference or a permanent difference? It's a permanent difference. Okay, question 36. If the carrying amount of a liability temporarily exceeds its tax base, deferred tax liability equals to carrying amount minus your tax base into your tax rate. Now you need to be very vigilant that over here we are talking about an asset, carrying amount of the asset and tax base of the asset. If your carrying amount is more than your tax base, then deferred tax liability is generated because this is positive. If carrying amount is less than your tax base, then this would be negative deferred tax liability. Negative deferred tax liability means what? Deferred tax asset. But this is again for your assets. If it is your liability, then if your carrying amount is more than your tax base, this is for your liability, then deferred tax asset would be generated. If your carrying amount is less than your tax base, then your deferred tax liability would be generated. Very important, the most important relationship in this reading. 37. When a capital expenditure is incurred with a depreciation period of 7 years for accounting purposes but 6 years for tax purposes. Now this is your accounting book and this is your tax book. So where would the depreciation be higher? In tax books your depreciation would be higher. Why? Because we are only using 6 years. And in your accounting book your depreciation would be lower. Why? Because we are using 7 years. More years means less depreciation. EBT would be higher over here, your taxes would be higher. Over here your EBT would be lower, your taxes would be lower. So you are paying lower taxes as compared to what you should be paying. Hence your deferred tax liability or deferred tax asset would be generated. Liability. Question number 42. A valuation allowance for doubtful deferred taxes is most likely required under GAAP. What does IFRS say? Write down directly. Question number 43. The most likely impact of creating a valuation allowance. Now why would you create a valuation allowance? Yeah, we are forecasting that the profitability is going down. If profitability is going down, then are you paying taxes? If your profitability is going down, then obviously you are not paying taxes. If you are not paying taxes and when the profitability goes down or when we are incurring losses, taxes goes down. In losses we don't have taxes. So when we are not paying any taxes, is there any worth of deferred tax assets? Because deferred tax asset, the utility of deferred tax asset is to lower your taxes in the future. The utility is to lower taxes in future. But in your future you are incurring losses, you are already not paying taxes. So is there any utility left for deferred tax asset? No. Then what do? You create valuation allowance. In your valuation allowance, deferred tax asset is reduced. So what is the correct option? A decrease in the income in the period when the allowance is created? Yes, a decrease in income. An increase in the income in the period when allowance is created? This is not the case. The income is not increased. No effect on the income statement. There will be an impact on the income statement. Why there will be impact on the income statement? Because your profitability is going down. So out of these three options, the first option is the most sound. So we create valuation allowance when profitability is going down. So option A is correct. Question number 44. In 2016, company has deferred tax liability which is expected to reverse in 2017. This deferred tax liability should be measured at what rate? At the most recent rate, the tax rate expected in 2017. Why? Because it is expected to reverse in 2017. Question number 45. Now this is a trick question. This is a trick question. Now the curriculum in itself hasn't given a lot of explanation on this. The curriculum hasn't touched into detail. It has just showed how you need to do it. I'm going to give you a logic, and that's the logic what the curriculum has given, and the curriculum doesn't go beyond that. So we shouldn't be going beyond as well. Okay. Now ABC in company depreciates equipment using straight line method for financial reporting and an accelerated method for tax reporting. What would be generated? Deferred tax liability. Straight line method for financial reporting and accelerated method for tax reporting. Accelerated method means higher depreciation, lower EBT, lower taxes in tax books. So lower taxes in tax books means deferred tax liability. The carrying amount and tax base on 31st December 2017 are given below. So carrying amount is to 700,000 and your tax base is 300,000. So carrying amount minus tax base into tax rate would be how much? Okay, so the tax rate is 30%. So 700 minus 300 into 0.3 is what? 120,000. Now the second leg of the question says the equipment was revalued upwards in revalued upwards by 100,000. Now IFRS we can use revaluation model. In revaluation model, when the value of the asset goes up, long-lived asset goes up, it immediately goes where? If the asset goes up, it goes to equity, and where in equity? Revaluation surplus account. If it goes down, it hits income statement. Okay? Now, the equipment was revalued upward by 100,000 in 1st January 2017. So your equity is going up by how much? 100,000. We need to remove this impact of increase in equity. We have to remove this impact on increase in equity. So first of all, this option A is 120,000. 120,000 is coming from here. Then it is, first of all, logic says that this will not be the answer, because this is the most easiest thing you can come up with. Now how can we remove this impact of 100,000? That is, the curriculum says 100,000 multiplied by the tax rate, that is 0.3. How much is that? 30,000. Your deferred tax liability would be 120,000 minus 30,000. That is your 90,000. So the correct option is B. So we deduct what? The impact of revaluation surplus. We reduce the impact. And how do we reduce the impact? Revaluation surplus multiplied by tax rate. Question number 46. National company follows US GAAP to report its financial statements. In 2017, National records a valuation allowance of 3905 against a total deferred tax assets of 21764. In 2016, National recorded a valuation of 2870 against a total deferred tax asset of 18. The valuation allowance actually increased. Valuation allowance in 2016 was how much? 28. Valuation allowance in 2017 is how much? 3905. Now the valuation allowance is increasing. What is happening? Valuation allowance increase. It is good for profitability or bad for profitability? Bad for profitability, because you are forecasting profitability to go down. That is the reason why profitability to go down, because if profitability goes down, you pay no taxes. Then there is no purpose of deferred tax asset, because deferred tax asset, the utility of deferred tax asset is to reduce your taxes. When the utility is not being served of deferred tax asset, then what do? We reduce deferred tax asset. And how do we reduce deferred tax asset? By increasing valuation allowance. Then what's the correct option? Expectations of future earning power have decreased. Yes, if your future expectation of reduced profitability or reduced net income or earning, what do? We increase our valuation allowance and decrease what? Deferred tax assets. Question number 47. Very good question. APL Corp reported a total deferred tax assets in 2017 for 45,189, offset by 45,189 valuation allowance. APL Corp most likely. Now, why they have offset deferred tax asset? Because deferred tax asset, what is the utility of deferred tax asset? To reduce taxes. That is not being served. Why that is not being served? Because you are incurring a loss. Because when you are incurring a loss, you don't pay any taxes. And there is a life of deferred tax asset, as we have discussed before. Then the life is also being finished. Then what is the correct option? C. Expect not to earn any taxable income before the deferred tax asset expires. So let's suppose you have a deferred tax asset of 1,000 and it will be going to expire next year. So there is no purpose of that deferred tax asset in your books. That is going to expire. And there is a loss. So you are already not paying any taxes in the future. So what we need to do with this deferred tax asset? Remove it. How we will going to remove it? Through valuation allowance. Question 48. Let's read. An increase in the tax rate would most likely hurt the company's. This is your balance sheet. So let's read the options we have. An increase in your tax rate will most likely hurt the company's income statement and balance sheet. Only income statement but not the balance sheet. Only balance sheet but not the income statement. Now use your logic. If your taxes increases, will it hurt your income statement? Why not? Income tax. Increase in your tax rate will going to hurt your income statement. And how will it hurt your balance sheet? Yes, we do have deferred tax liabilities. We do have deferred tax liability. So if we have a deferred tax liability, then it will going to hurt. So your deferred tax liabilities are there. Your deferred tax asset is 15,000. Your deferred tax liability is 30,000. So your net deferred tax liability is 15,430. So your net deferred tax, you always see what? Net. If it was deferred tax asset, then if the interest rate increases, your deferred tax asset increases. It is not actually hurting you, it is benefiting you. So what is the correct option? A. Again the same question, the tax effects of temporary difference that give rise to deferred tax asset and liabilities. Now, had the valuation allowance been the same in 2017 as it was in 2016? Now, think about this question. Use elimination method in this question. The company would have reported higher net income. Let's talk about net income and deferred tax asset. So let's talk about net income and deferred tax assets. Okay. So if your valuation allowance in 2017 is the same as was in 2016, so instead of 2236, it is 2945. So it is more than 2236. So if we would have used 2016 valuation allowance instead of 2017, now your valuation allowance has gone down. What does it mean? It means improve in profitability or reduce reduction in profitability? Improvement. As your valuation allowance decreases, there is an improvement in profitability. Over here, it is 2236. If it increases to 2945, what do you expect to happen to net income? It is not good. for your net income. And deferred tax asset, again, what is happening? Instead of reducing 2236, you are reducing what to deferred tax asset? We are reducing deferred tax asset or increasing deferred tax asset? If we increase valuation allowance, look, valuation allowance is being increased. Valuation allowance increase, what is happening to your profitability? Go down. What is happening to your deferred tax asset? Again go down. Had the valuation allowance been the same in 2017, now your valuation allowance has gone up. That is bad for what? Deferred tax asset will go down. Your net income will go down. Why? Because your valuation allowance has gone up. The company would have reported a higher income tax provision. Now, the other name for income tax provision is income tax expense. Now, this is my brain that is working now. Okay. Now, this is not what is required from you guys. This is what I am telling you. This is how I think, but this is how you are going to solve the question. Valuation allowance goes up. What happens to your deferred tax asset? It goes down. Net income goes down. Income tax provision, the other name for income tax provision is income tax expense. Income tax expense. Income tax payable plus change in deferred tax liability minus change in deferred tax asset. If this goes down, minus goes down, this goes up. Question number 50. The tax effects of temporary difference that give rise to deferred tax asset and liabilities are, you are given this. The comparison to the income tax provision in 2017, the company tax payment in cash were. So how much was your deferred tax liability in 2016? 25,489. This is what you owe. How much is that now in 2017? 15,430. How come your liability went down? You paid. So what is happening to your cash payments? Company tax payment in cash were company tax payment. Your payments were higher because you paid more cash. You paid more cash. That is the reason your liability came down. Your liability came down. So what's the correct option? C. Okay, last question. Aztec company incurred a capitalized 2 million of development costs during the year. These costs were fully deductible immediately for tax purpose. So again, accounting book and tax book. Expense is happening immediately. It goes up. EBT goes down. Taxes goes down. But the company is depreciating them over 2 years for financial reporting. So over here capitalization is taking place. So the taxes would be higher. So you are paying low taxes. So what is being generated? Deferred tax liability. A liability is generated. So the analyst should include it in assets. No. In equity. No. In your liability. And why not in equity? Because it is a temporary difference. Deferred tax liability would be generated. The analyst should include it in liability when calculating the company's debt to equity ratio.